And I believe we are live. And welcome everyone to Property Development Australia Facebook page. And I know we met last night on the business of property, but we've got a very special event today and a very special guest. We have Archistar who are sponsoring this event, but we decided we'd invite leading property expert and chief economist, Dr. Andrew Wilson, to the group to be able to give us a bit of a market update. There's been a lot happening at the moment. If you haven't noticed, you really have been in deep isolation. But Dr. Wilson from My Housing Market will be shortly giving us a bit of a property market update. And obviously he's been working with a lot of numbers. Keen to understand, Andrew, if this so-called recession that we are in is it going to be horrible? Is it going to be great? Be keen to hear your thoughts on that. And we'll be shortly followed by David Hunt from Archistar providing a session on how you can find profitable development sites in the current climate. So welcome Andrew and David to the stage.
Thank you,
very
Cheryl.
glad. You might not be able to see people because this goes on to the Facebook Live. If anyone wants to join the actual Zoom room, there is a link. But what generally happens is if anyone has any questions, I will sort of call them out to you. But what we'll do, the format is Andrew's put together a little few slides to begin with, and then we'll head off to David and then have a Q&A. Does that work for everyone?
Yep.
Excellent. So where are we at, Andrew? How are things looking for our property market? Should we be heading for the hills?
Well, the hills, the beach, all those places where property is
open now. They're all open now.
Well, they're all open now, except for Queensland, but that's another story. But look, thanks for that, Cheryl. And there's no doubt that not just the issues to do with the shutdown are improving, that also our sense of where the economy is and the housing market is also improving. I think actually and look, I'm not blaming those that were making, what were quite, severe predictions as to the direction of the economy and the housing market, starting to think twice about the severity of the economic issues we will be confronting, and also the housing market, because the signs are certainly a lot better. And I think we're working on a rebound from confidence as the shutdown now eases. I think people are feeling a lot better about getting out and about and getting back to normal. And that means becoming involved in property. So that's a good thing. I'm going to look at it's only a short presentation today, 15 or 20 minutes. So I'm not going to load up on data. It'll be a bit of a history lesson to start with in terms of where our housing markets have been and where they landed until the coronavirus struck, and some of the reasons why. But importantly, and I think this works to the general theme that David's going to be following up with, and that's about looking at real-time data and insights into the marketplace. And of course, that's a fundamental necessity for those that are professional developers to understand what's happening in the market as close to the event as possible. So I've got some new data models that we'll look at that are giving us some insights in more of a real-time environment compared to what we typically use, such as price data, to understand what's in the market. So shall I begin, Cheryl? I have a limited time here, so I don't want to be...
Press the green light. Yes, please go ahead.
So I shall start my my presentation, and let's get going. So I've been a property economist for more years than I like to think. I currently work as an independent consultant, and my brand is My Housing Market. My previous formal role prior to moving out on my own was as Chief Economist for the Domain Group. I was there for around 10 years. So, and I've had various other bits and pieces in terms of being a property economist over frighteningly a couple of decades at least. But so let's get into the meat and potatoes. Enough about me. So let's have a look at the key drivers of our housing markets, and they are fundamentally people, of course, who have to live somewhere. And look, a prime measure for that demand side of the equation is migration. And of course, we are going to have some issues in regard to migration going forward as a result of the coronavirus shutdown. Migration, however, is important, not just international migration, but local migration as well. So we'll have a quick look at how that is tracking pre-coronavirus and its impact on our housing markets. And of course, the response to demand from people looking to live somewhere is the building industry, and that's home building. So we'll also look at how home building's been going just quickly. But the glue that holds everything together, and I guess the key to the future, is the economy, particularly interest rates. And we are in a different position now in terms of interest rates, which have been the sort of the glue that holds supply and demand together in our housing markets, because of course, as we know, we're basically at zero with interest rates, official rates at 0.25%. Probably won't move much from there for a number of years. The Reserve Bank has confirmed that. We really, prior to the coronavirus, didn't have much prospect of interest rates increasing in the future because of the nature of the local and international economic environment. But certainly interest rates have been a key to the cycle for the last few decades. And that's the difference now, is that we don't have that same drive from interest rate movements. But one of the, I guess, prime factors in regard to low interest rates or zero interest rates is that this time around, in terms of looking for economic stimulus, we don't have the capacity to cut rates as we have in previous economic downturns. So it does restrict our policymakers to fiscal policy, government spending, because we don't have the drive to push into the economy from lower interest rates. So interest rates generate house price growth, but local factors determine the rate of growth. And of course, with interest rates being off the table now for the foreseeable future, it will be more about local factors determining the rate of growth. And look, that's something at least we can use in terms of our analytics to drill down into the significance of local factors without having the, I guess, the unknowns to some degree, particularly in terms of the development horizon of where interest rates will fall. So this is the track of interest rates over the last 15 years. We can see that typical roller coaster ride of rates. We had a strong economy through that first mining boom in 2007, 2008. A Reserve Bank increased rates then. We had high inflation to take the heat out of the economy. Too much demand, not enough supply. Higher interest rates takes money out of mortgage payers' pockets by having to pay higher rates. And of course, businesses have to pay more for their overdrafts. And the plan is to take the heat out of the economy. And that occurred, of course, but along came the GFC. It never rains, it pours. International economic shock. And the Reserve Bank cut rates to put money back in consumers' pockets and also to put money back in businesses' pockets. And we saw the mortgage rate fall from just under 10% to just under 6% during that period. Mining boom number 2 came along. Thank you, China, in terms of those exports of iron ore and coal. Our economy took off again. The Reserve Bank pushed up rates as our economy overheated. But since the end of mining boom number 2, we've really had a consistent journey of lower rates. Not completely consistent. We've had not the Reserve Bank increasing rates, but we saw rate increases in 2015, 16, and then again in 2018, 19, courtesy of APRA, who determined at that time that there was too much demand in housing markets, particularly from investors. So they targeted investors, and higher interest rates and restrictive lending, credit squeeze, meant that we had reduced activity. But since 2019, of course, we've seen rates continue to fall. And this is the March quarter numbers there at 4.5%. Since then, of course, rates have now fallen again with those cuts from the Reserve Bank, those coronavirus cuts from the Reserve Bank. And we now have mortgage rates looking at around about 3, and who knows, maybe even 2 something going forward, which is good news for mortgage holders. Now, of course, what we're interested in is the housing market, and this is the response of housing markets to those cut to interest rates, and typically, or rises in interest rate changes, and typically you can see higher prices from lower rates as affordability improves, lower prices from higher rates as affordability declines. And we've seen, the local impacts can be different. And if we look at the various cycles there just quickly, the gold cycle at the top there is Sydney. The black cycle is Melbourne. They were very strong markets as interest rates declined from 2013 onwards. Sydney market was particularly driven by investors, hence the concern from APRA. And you can see as those interest rates increased in 2015-16, the market fell down as investor numbers were reduced. Melbourne and Sydney also were the beneficiaries of a record migration. Remember, we spoke about migration before, but that record migration also fueled the Melbourne and Sydney housing markets, particularly Melbourne. But with those higher rates in 2019, it really was the beginning of the end for our housing markets. And there was a period, if we remember back 12 months, of very negative sentiment, predictions of quite ridiculous price declines in Melbourne and Sydney. Last year had buyers and sellers sitting on their hands through the end of 2018 and into 2019. Of course, those predictions were, as usual, wrong. The markets rebounded through the second half of last year, courtesy of lower rates. But that was driven by particularly owner-occupiers back in the market, with those prices being lower than where they were at their previous peaks in 2017. So it was the value equation, the value perceptions from owner-occupiers and low rates that brought them back into the marketplace last year. And even over the first quarter this year, prior to the coronavirus, markets were still growing strongly. And that was, again, a product of those value hunters in the marketplace, and a lot of momentum with the positive vibe offsetting what was the negative vibe 12 months ago. We look at those smaller markets just quickly. The Brisbane market's the third cycle from the top. It had also started to improve its growth rates at the second half of last year with lower interest rates. But the Brisbane market's been reasonably resilient given a number of headwinds that it faced. Again, we're talking about local factors, how that offsets the interest rate equation. But Brisbane, of course, had the flood. It had the way back in 2011-12, it had some issues, local economic issues with a lot of job shedding through the previous government. And of course, there were cyclones, the credit squeeze, which affected everybody. But the Brisbane market up until that late 2018-19 period was growing at around 5% per year. And the other factor that was dragging Brisbane down was a decline in migration due to the end of the mining boom. So look, just a quick history lesson. This is where our markets landed prior to coronavirus. Prior to coronavirus, we were looking, I believe, at 10% growth in Melbourne and Sydney this year, around 8% in Brisbane, and reasonable growth in the other markets as well. Of course, Perth being the underperformer because it, more than any other market, suffered from the end of the mining boom, the fly-in, fly-outs, flying out and not coming back in again. And that Perth market had just started to show signs of life when, of course, coronavirus hit. So just a brief history lesson there. Of course, last week we had the official GDP numbers out. No surprise that they were down on the previous December quarter, March quarter down by 0.3%. So we've now had our first quarter of negative growth. We will have a follow-up over the June quarter. So we will enter our first official recession, consecutive quarters of negative growth, when that is announced in 3 months' time. I actually, to some degree, think it was a positive, believe it or not, that we did have that negative growth, which was just below the line over the March quarter, because it gets the doom and gloom headline out of the way. We're all basically accepting that there is a recession at the moment, which there is, but not officially until we get the data. But nonetheless, it does mean that that recession doom and gloom headline is now out of the way. and it will be diluted rather than having to wait until January next year and have that bad news cycle continuing to impact consumer sentiment. We, of course, have seen our unemployment rate surging, no surprise. The latest data, the April data, up from 5.2% to 6.2%. That wasn't a bad result. It surprised a lot because there were predictions of higher unemployment. But the reason the numbers were better than expected was a falling in the participation rate. Actually, 536,000 people gave up looking for work. So if they had have been counted with those that lost jobs, which rather than leaving the workforce, we actually would have had an unemployment rate of 9.7%. So if the participation rate had have remained where it was prior to the coronavirus, our participation rate would have been at around 10%. So given that sharp fall in the participation rate, which we're unlikely to see repeated, and I think the majority of our job shedding has happened, it will continue, but certainly not at, let's hope not anyway, at over 500,000 a month. I think that we may see a better prospect in terms of the unemployment rate this year. I'm not sure we'll get an unemployment rate at 10% this year. And I think that's good news in terms of the predictions, and some of them, again, were quite extreme. And I think that'll be another positive for consumers and businesses if we can maintain a reasonable unemployment rate. Of course, the US announced its unemployment rate for May last week. And again, it surprised a lot of the commentators who were predicting a 20% rate. In fact, it came in at 13%. It fell away quite sharply. And I think that what we're going to see is more jobs than were anticipated being created just through a normal process rather than government policies being created as the coronavirus shutdown starts to ease. Sydney's still the top economy, unemployment rate at 6%. At the moment, it's up from 4.6%, but other capital cities are significantly higher. Now, Perth, as I said before, its economy is improving, and that's producing unemployment rates now better than anywhere except for Sydney. Migration, of course, is very important. The government has predicted an 85% fall in migration. I think it's up to the government to enact policies that will offset that prospect. It's important migration for job creation. Of course, there are issues and questions over whether high levels of migration acts to curb income growth because we have a high supply of labour. But nonetheless, we are a high migration country, and particularly reflected in our housing market activity because people have to live somewhere, and more people come in here, the more demand there is for dwellings. And of course, that's good news for the supply side. So hopefully the government will be able to moderate the level of decline in migration that is predicted, because that is an important factor for our housing markets. And if we look just quickly at migration levels for each of the states, we can see that part of the decline in our housing market activity through 18-19 was a decline in migration into New South Wales and Victoria. But the reverse to that was a pickup in migration in Queensland. And I think what we've seen is, as a result of that, is increased demand in the Brisbane housing market. And a lot of that is been shifted up from declines in the in New South Wales migration. Net migration, interstate migration is very strong into Queensland. This is total migration, these charts, but net interstate migration is the strongest into Queensland of all the states, and it's the weakest out of New South Wales of all the states. Of course, migration wasn't a key factor in our housing market revivals last year, as it was local owner occupiers that drove the Melbourne and Sydney price revival over last year. So new supply, of course, particularly as a response to those APRA actions, we've seen a sharp decline in new building in this country. This is prior to coronavirus. So this is the year to April versus the previous year. And we've seen particularly strong declines in unit development coming off the back of what were record unit development activity in most capital city markets. So in a way, we've come to obviously a restrictive environment for new building courtesy of coronavirus from a very low base, which isn't good. So the outlook for this year in terms of the housing market, coronavirus shock has certainly placed our economy and housing markets on hold. I think that really the housing market has performed quite reasonably given the shutdown. It wasn't really a halting of housing market activity. It fell away, but buying and selling was still being conducted, and we're seeing a real revival now in housing markets as a result of improved consumer confidence and people now moving out of the shutdown process. So our underlying factors clearly remain positive for continuing to solid growth once we get our economy back on track. Governments have got to do really whatever it takes to revitalise the economy with minimal loss to offset the damage of their shutdown policies. I think that we're more and more looking for a reasonable prospect for a gradual spring revival in our markets. We're certainly seeing some good signs now going forward that buyers and sellers are back into the marketplace. Some policies, we've had policies announced, of course, the new building grants and the supports for renovations. I'm not so sure about the renovation policy, but remains to be seen whether these are effective. But certainly we need to support migration levels. International students are important. We need to get our borders open and support tourism, interstate tourism. Think about perhaps some stamp duty exemptions over the short term. Maybe even look to have new purchases for mortgages for new purchases tax deductible over a short period. We've got to look to first home buyers, as we've done in previous downturns, to get demand up and running. First home buyers tend to have a more positive attitude to being in the market regardless of the economic circumstances. Maybe we could look at some short-term capital gains, full exemptions for investors, look to fast-track financing for investors and development, ease residential planning restrictions, and also ease constraints for international investors and developers, given that those constraints were placed a couple of years ago, which was quite cynical and nonsensical. And that's all about unleashing pent-up demand and creating jobs through the private sector. So just a quick update. Last weekend, and this is more about the real-time data that I discussed at the beginning. Last week's auction clearance rates, of course, auction clearance rates have really been not a lot of use in terms of looking at the market in a real-time basis for the last couple of months because of the shutdown of open-air auctions. They're back up now, open-air auctions, but we're not going to see the full market return for at least another couple of weeks. And of course, we are into the winter market, which is traditionally a quieter period for auction activity anyway. But for what it's worth, these are last Saturday's results. Again, Sydney's really looking as a standout in the market at the moment. In fact, its listings were higher than where they were over the Queen's birthday last year, which is quite remarkable. But Sydney's auction listings have been closer to where they were a year ago than any of the other capital city markets. The smaller markets are really conducting very few auctions, and Melbourne's well down on the numbers it's been typically used to. Melbourne's the strongest auction market. But look, clearance rates over 60%. Got to understand a lot of this data we need to take with a grain of salt because these auctions are online auctions, the vast majority of them, and we're not sure how that's measured compared to as we traditionally measure open air auctions. But that's last Saturday's auction results. I run a measure of real-time seller data. So I track the number of newly listed homes on a daily basis over the previous week, day to day. And over the past week, we've seen a real surge in properties coming into the market. These are newly listed homes coming into the market. It fell away over the last days, given the shutdown or the distractions of the Queen's birthday long weekend. But up until then, the market was really picking up. And I think that's just a sign of consumer confidence increasing with the shutdown now easing. But no doubt that index is a positive result for markets reviving. And of of course, sellers are quite happy to move back into the marketplace now. If we look at on a capital city basis, we can see a big surge over the past week in Sydney, Melbourne and Brisbane in terms of new listings coming into the property market. Adelaide's still a little quiet, but also Perth up quite strongly. So particularly Melbourne and Brisbane up quite strongly in terms of new listings over the past week. And we can see that Melbourne has the greatest share or has the most new listings coming into the market using Sydney as a base there at 100. Sydney sales are also starting to pick up. These are sales, weekly sales, home sales. Of course, sales have been affected by fewer auctions in the market. I haven't got the breakdown here, but this is total sales, auctions and private treaty, but on the rise as well with listings. And again, it's reinforcing that Sydney appeals as the strongest market at the moment. Melbourne, not so strong in terms of new sales coming through, even though it's new listings are quite strong at the moment. New sales are still quite flat. And I think, again, that's a product of Melbourne having more auction activity than any of the other capital city markets. And that's really impacting sales numbers with very few auction sales at the moment. And you can see that when we compare sales using Sydney as a base, Melbourne is well below Sydney, and Sydney is clearly the leader in terms of that relativity index for new sales. And just talking about sentiment, not something I usually do, but we are seeing a strong revival in the share market as well. And I think that's another reflection of consumer confidence reviving. And this again has surprised a lot in terms of predictions of a significant decline in the share market, but up above 6,000 now, again, the All Ords. Now it'll be tested as the data comes through, particularly the unemployment data. But as I said, I think the prospects of better news than has been predicted, I think, are now quite rational. And that's the stock market's response is just another, I guess, more of a real-time reflection of sentiment. So, I mean, I'm just going to finish up now. Misinformation and ignorance remain the curse of Australian housing markets. I mean, my brief is always to be able to provide, commentary based on more real-time information. That's why the sort of models I've been developing are more reliable in terms of a live market than the price data that we rely on. Of course, the latest price data was telling us that markets were falling away, and we have to wait for another few weeks before we get the latest update. So there are better measures to look at. And I think that's the whole point that David is talking about, is having a more reliable and robust analytical tool set for developers, obviously, because that's so important for their feasibility environment. And of course, how housing markets are acting in real time is critical to those feasibility studies. And of course, that sort of takes a lot of that fear and greed equation out of developer decision making. And look, I think that we are a hostage in this country, unfortunately, to a lot of misinformation and ignorance in regard to our housing markets. We've had, we're always, being confronted with, crazy headlines about booms and busts. And the reality is that we have quite a robust and resilient housing market, and that's been proven for decades. I think it's been proven now with certainly a reasonable prospects of an earlier revival than many people predicted. So just the last thing, a little bit of an ad from me. I am providing or working on more comprehensive live market insights. Look for some applications around that particular brand, building economics. We're working on a suite of digital applications providing real-time market insights. For example, I have an app which is just about to come out, which looks at all our local government areas nationally. And for that, you can filter building types, units and townhouses, and then filter for the number of beds and total, 1, 2, 3, 4 beds in total. And this is all for properties that are currently listed for sale in the market. And that will give you the data for number listed, the median asking price, the high price, the low price, the median building size, the median asking price per square metre building size. And look, that's updated daily, that data. It covers the whole market, and it is part of this live environment. So developers particularly can have their decision making more about real time rather than backward looking. So that's it for me. I've, as usual, gone a little bit over time. I hope there's some good information for you, but certainly I think the big picture is that the prospects are better going forward than what we thought even a couple of weeks ago. And again, it reinforces the resilience of our housing markets. Now, to some degree, it's still up to the government to fertilise the revival. They've started off okay, I guess, but I think there's more work to be done from the government. So thank you very much for that, Cheryl, and I'll hand it back to you.
Thank you, Andrew. And we've got a few questions, but we'll keep them to the end. What we might do a bit of a pass over to David. So David Hunt is from Archistar, and a few of you may have seen David in previous presentations, but he's gonna, one of the things that we spoke about is the ability for developers to be able to basically filter through using Archistar and finding profitable development sites. So during this session, David's going to show us how to rapidly find sites and produce feasibility reports and architectural designs using Archistar's technology. So David, over to you.
Thanks very much, Cheryl. It's great to be here today and chat to everybody about finding profitable development sites in the current market. What I want to do here today is just introduce Archistar to everybody, our amazing technology, and also give everybody a bit of a live demonstration of how it all works and how to benefit from it. So, look, first of all, so for those of you that don't know, Archistar, is a property and an architectural technology company founded by Dr. Ben Curry. So Ben is a world expert in generative design, which is basically bringing buildings up out of the ground using geometry and algorithms. So at the heart of it, Archistar is really a change agent for architecture around the world using technology. And look, some 3 years ago, Archistar actually hosted an event called Digital Design 2020 and did a national tour. And at that point, we basically, Ben said that we'd be able to start to bring buildings up out of the ground digitally in a couple of years' time. So basically, you can do an instant feasibility, get some sunlight analysis, cross ventilation analysis, and many different building designs in seconds. And it was quite phenomenal that we could make this happen in just a few short years. And we went live with the property platform almost 2 years ago. And we spent a lot of time with developers, architects, real estate agents, making sure that we were basically satisfying their needs in developing the platform. So originally, we basically thought we were developing building design software, but when we started using when our customers started using the platform, they said, we don't know what the planning regulations are. We looked them up. It takes hours a day. We start downloading. So we started downloading all the rules and working how much of the puzzle we could help people with. And now we're very useful at the research stage, acquisition stage, design and sales stages. So we've really aimed to improve efficiency for the whole market. Interesting enough, if we look here, and this would all make sense. This is the life cycle of a project, starting from concept through to construction. So the later you get here in the construction cycle, the more expensive it is to change design. So if we look here at the McLeamy curve, the cost and impact of these stages, as you go along the curve and you go along that green line, each stage you go through, the cost of design changes significantly. And once you get to construction documentation, past DA stage, if you want to make some changes after that, it's very difficult to do. So you were seeing you have a very low ability to impact cost and function capability. So what Archistar is doing is basically shifting the curve. So how much more power can we give to users at the start of the process to change things instead of the middle and end of the process where it's too hard and expensive. So the way that Archistar works is basically we have 4 different pieces of technology that work together. And we're going to run through how they work, how the system works today. And because this is about, we're talking about property development, we're going to show you basically how to use the platform to find profitable development sites, which in today's market, is very, very beneficial because, in the current climate, more and more opportunities are going to come up for property developers. So essentially, when you're looking for sites, what you need to know is the planning regulations that are there at the moment. And we thought this would be really easy and we'd be able to go to data sources and connect some APIs and, it'd be so easy. Unfortunately, it was a bit harder than that. And it's taken us 80,000 man hours to go right around Australia to source and document planning rules. We've actually mapped more than 266 million planning rules to properties. And if you've been through the planning process, which most of you would, it could be weeks of work. And now it can just take a few seconds. You can go into any property in Australia and obtain planning regulations. The only, we're basically covering the whole country. And just finally, if you look at this particular slide, we're covering 11 million properties. So if you look here, 95% of properties are mapped over 11 million. So that's just to give you just a little bit of a grounding. And now I'm going to actually move onto the platform and give you a full demonstration. So we're now on the Archistar platform. And so let me show you how you find profitable development sites. So I'm just going to go to, I'll just go to a place called Guildford, which is a suburb in Sydney. So I've just typed in that particular suburb. I could actually type in an address if I so wished. Now looking at this suburb, I then come here and go into filters and I might say, look, I'm looking for a townhouse site. So now the platform highlights anywhere that I can develop townhouses. Now there's a lot of other functionality here. There's an algorithm for underdeveloped sites. I can look up apartment sites, mixed use. I can look at minimum and maximum size lots, floor space ratio. I can even look for empty lots and they'll appear. So a lot of work has gone into this particular search tool. But at a very basic level, so I've highlighted these. I'm saying, okay, so where now can I find a site? So I'll pop here onto our add-ons. I'll turn on Near Map. And now I can have a look around here and I can see where I can build townhouses and see what's underneath here. And Near Map it's quite expensive to buy on its own, and it's the most updated high resolution aerial mapping platform available. So if we just look here, I'm just going to turn off this aerial shot. And what I'm going to do now is I'm going to turn on Cordell. And my history is I ran the Cordell projects business for a number of years. And with Cordell tracks all project information, right from planning through to construction. So basically, I can start to see, projects that are being approved in the area. So, and that's really good because it's one thing the planning control saying you can do something, but it's another thing. It's another thing for to know exactly who's been able to push the envelope. And so just looking around this little area here, I'll just turn back on Near Map, and there's something here. So if I was to go into this particular property here, I can see basically there's a proposed demolition construction of 3 by 2 story attached dwellings, so like townhouses, and due to start in April. So I can see what's happened there. And now, if I'm looking around here at other sites, and I could probe deeper into that site, but if I just come over to this one over here, say, so I've just clicked on this particular site, which is in the same area, straight away the platform does tell me that I can do townhouses. It's R3 medium density in New South Wales, which is townhouses. It's 1,818 square meters, and you can see all the controls here. I can go in here and I can see what's permitted with consent, what's permitted without consent, what's prohibited. I've got the lot ID, council, Cumberland Council. You can see all that there. Maximum building height, site coverage, minimum lot size. I can go here and I can look a lot deeper at the controls here with planning regs, with setbacks for attached, detached. So it's all there at a glance, even any overlay information. So and then I can link into the planning documents. So we've got Australia's biggest digital planning library as well, which basically sources where we're getting our information from. So you can see the amount of work that's gone into this. There's also deep linkage into RP data. So if you have an RP data subscription, you could go straight into RP data on this particular property and see what's there. And there's also, and if you do have RP data, you can actually get an AVM, what's when it's sold, last sold. You can look at rental history. And the AVM for this property is 1.1 million at a mid-range, 904 to 1.2 according to CoreLogic. So really valuable insights. So just to explore this a bit further, and I'll just turn off Nearmap and I'll just show you these incredible layers here. So Australia's biggest zoning database, so you can see how the zoning works. It's all there. There's a maximum building height layer. So you can see the differences in heights in 3D. Lot area, which is another really cool type of display. So the darker lots are a little bit bigger. So it's showing you that at a visual level. 2D contours. We've even got 3D contours, which is really great to be able to see. So you go here and you can see the contour around that particular site. Take it to another level, really important information to have, flood. So I turn here on flood, and if there were any flood areas around this particular site, it would highlight. The same with bushfire. There isn't any bushfire around this particular area, but it would show you those exact areas. Even heritage. So any heritage properties get shown, and you can see a couple coming up here. We have the 3D current housing footprint, which is updated every 3 months by PSME data, which is really great to be able to see the existing footprint in 3D as well. And even access to railway lines, they'll pop up to show you any proximity to railway lines. So you can see there's the railway line there. And that's a 400 meters radius around the station. So it's about 10 minutes walk to the station or thereabouts. Handy to know, just off the cuff. And even points of interest like schools. So it's drawing 400 meter radius around all the schools close to that particular property. So to have all that information there is really giving you great insights about that particular site in that area. If I was to go even deeper here, I can look at, and I want to look at this area and see how it's traveling. I can go here into domain data, and now it's basically showing you everything that's for rent, for sale, that's been sold. So you've got access to this information. A closed square is for rent and a closed circle is for sale. And even if I was to basically just click on there, it goes straight into it on Domain. So it's interesting. We're seeing that townhouses in this area are selling for $820 to $850. So you just, you've got that right there in front of you or on the market. And I mean, I can even go here to the property listings from Domain and look at a list. So at the moment, there's 88 properties for sale in Guildford. There's 149 for rent, 6 new sales, none shared accommodation, and there's the sold history. You can even go in here and look at some suburb insights according to Domain. So say for houses, medium house price 755, down 3.21 in the last 12%. Rental 460 a week. Numbers sold has increased over the last 12 months. Days on market, it's taking longer to sell, 104 days. And you can see the differences over the last 4 years with sales prices for units and houses, rental prices, total sold. Now, bear in mind, I'm only using Domain for that. What we've been able to do that no one else has been able to do is get CoreLogic and Domain on the same platform. So now you're really seeing the full pie. So by having both together, then nothing is being missed. Both data sources will say that they cover the whole market, but when you've got both, you are seeing everything. And again, suburb insights, same sort of process from CoreLogic as with Domain. And interesting enough, you start to see similar trends. Also the same for commercial real estate. So we have commercialrealestate.com mapped as well. So I can turn on all the commercial real estate. And I mentioned Cordell, which I've got on at the moment, which is absolutely gold for a developer to have. I did show you, and Cordell's track and monitoring every construction project, right from planning through to construction. So anything green there has been approved. I'll just turn off Domain, but any green triangle has been approved, and you can go straight into that, or you can go into a list view, which is even easier, or a table view, and then I can use this to look for, and this is just covering Guildford, so I can go in here and say, look, I'm just looking for properties that have been approved, that are in residential, and there they are, and I can start to do a little bit of homework, one here, and start to see what's going on. And then I can actually go into that property on the platform. So, really valuable research to be able to do for any developer that's looking to buy a site. And certainly in the current times, not only are these current projects, maybe some of them may even be potential to buy, because, some developers, for instance, in the current climate may need to sell a site in order to fund a couple of others that they're building. So those opportunities which are not normally there could be there. So certainly an opportunity to chase those down as well as put sites together. All right, so just going back into analyzing that particular site, just to show you what you would do. So we uncovered that opportunity before. And I'll just go back to it. I think it was up here. So so it's pretty easy just to get back there, and I'll just flick on the near map here, and we'll see if we can just grab that particular site that we had. So I think we were looking around here. So and let's see what we can actually do with it. So we were up here somewhere. I think it was one of these ones up here, and sorry about this. I just lost it, but I'll get it back. Yeah. So this is the area we were just looking at. And if I was looking to maybe assess one of these sites, so even if it was just this one here, I could literally just go, in here because I know that there's one that's been approved very close by. So I'll just jump on here and you can see this is 541 square meters, and I could even add a lot. So now I've got 2 lots. So we've got 1,049 square meters, and I can go in here and I can do a very quick estimate. So I'm looking at townhouses, and basically 200 square meters per lot, which was on the controls. And I can just go in here and put in a few calculations. We might say that we'll sell one of these for 850,000 once completed. Maybe a construction cost, so we'll say 300. We'll say 180 square meter townhouse. Happy to make a profit of 20%. Other development costs are standard at 10%. So this is like a really quick calc, and basically just and it's saying I can get 5 on here just at a glance. So for those 2 sites, if I want to make that profit at a glance, I could get one. I could pay 1.33. That's at a minimum. Now it's a corner block. I might get 6 on there. But very quickly, you're able to sort of say, is this worthwhile proceeding with? And you can then go into our much more advanced technology, which is generative design, which is whereby we've built parametric design generators, which is allowing you to see different types of design strategies. So I could go on here and I could literally put a few inputs. It's a corner block, so we won't have any roads, and I'll just sort of, I might just put 180 square, 7, maybe 180 square meter townhouses, just without getting very precise. I'll make them attached and start to see what our generator will do. So I haven't spent a lot of time setting this, but you'll just get an idea of how it works. And it even gets much more advanced with subdivisions and apartments where we have sunlight analysis and unit mixes and ventilation. And so I just did it pretty quick, but it starts to look at different design strategies. So if I get my inputs right, it'll start to get the right amount of numbers on there. But this is just giving you a look at how it works, and you can do a quick feasibility here, which is more static. It even has Cordell costings coming into it on a rate per square meter. So with Cordell, there's like average, quality, and prestige, and it gets automatically loaded in there. And again, you can fill all this more detailed information out, from contingency, agents fees, legal fees, council contributions, and end up with a residual land value. And then what is also being produced here is a report, so a development due diligence report, which can be self-branded, which in photo, etc. And then you get a report with those properties all generated, and you can choose which pages you want in here. So it's got all the information on these properties and zoning, heritage, and you can just pick what you want. Even suburb insights for the last 12 months, as I showed you, what's recently sold, what's for sale, what's for rent, even those particular design strategies I did. So really advanced functionality. So, and when you're using this, as I said, it's just so easy. And I mean, you can look anywhere. It's national. So whatever state you're working in, it's a really easy way of having all these tools in the one place, helping you to uncover opportunities. So look, I just wanted to give you all a very quick briefing on that. Being mindful of time, we'll go to a Q&A in a moment. But just before that, I just wanted to also mention that today, because of our affiliation with Property Developers Facebook group, and with the help of our partners, there is a bit of an offer here if you want to test it out. You can get 1 month access to the platform on a no lock-in contract for $295 a month. Basically, one state, one user, all the data layers, all the premium add-ons, including Nearmap and Cordell, and all the mapped CoreLogic data and domain data, unlimited property development reports. You can start using our parametric design generators. You can assess sites up to 2,000 square meters. So I just thought I'd mention that. And, if you want to take that up and have a play with it for a month and see how you go, you can go to www.archistar.ai/PDA. Look, thanks very much. And I'll hand it back to Cheryl.
Thank you, David. And I'd like to say thank you for that offer. I do know, and those who haven't looked at Archistar before, that is a really, really great offer. And the power, and just like with anything else, if you're using the tools, and this really cuts down, I use it for our projects, and I use it for our clients as well, David. And it really cuts down on so much time having to sift through all the different platforms.
Yeah, no, definitely. I mean, it's
particularly if you're going through a lot of different sites as well. And I have to say, my favorite tool is that where you can find the underdeveloped sites.
Yeah, one of the big things, Cheryl, is that we've been able to open this technology up to anybody. It's just not reserved to the big end of town. So whether you're a small mum and dad developer, you're using the same tool that Stocklands are using nationally. So it's like we've now been able to make this sort of technology available to everybody. And we all know that one of the hardest things in property development is being able to find profitable development sites. And this technology and AI is a great way of helping property professionals.
And we might turn Andrew back on.
That sounds good.
That's you. We haven't lost you. Hold on, I've asked to start video. There we go. We have to see your pretty face. So we're going to open up the Q&A for at least the next 15 minutes to go back to your presentation, Andrew. And I've got a few questions to be able to kick things off, to start things rolling. And if anyone has any other questions, they usually put it on the Facebook group as well. I guess, and what I gathered from your slides and your research really is that one, the positive is it's not as bad as it looks.
Yep.
And two, that we are actually looking that we're on the right path towards recovery, despite the new banner of a recession.
Well, look, that's right, Cheryl. Look, the point is, it's interesting that in previous economic downturns, and we look back to the GFC, and of course, prior to that was the recession of 90 through to 92. And housing markets have actually performed quite reasonably during those periods. We haven't seen a real shakeout in house prices in 90 to 92. It was really only the Melbourne and Perth markets that fell away. And even then, the Melbourne market was down 6% over a couple of years, Perth down about 5%, but Brisbane and Sydney actually increased, and Brisbane quite strongly through that recession period. Now, one of the factors, of course, as I mentioned in the presentation, was that there was the capacity to cut interest rates sharply during those times, which of course improved affordability and activated or helped to bolster the market then, despite unemployment being over 10% in 91, 92. Now, we don't have that same capacity now to cut rates. So it is a different ball game. But you've got to remember that even if we do get to 10% unemployed, 90% of the workforce still have jobs. And those that are in the, I guess, the more secure income areas, still, after the short-term concerns about where the economy is going, do tend to continue to buy and sell property. And that's why we don't see the same impact on house prices during times of higher unemployment as we do during times of higher interest rates, which really is a negative factor in activity, as we saw with that credit squeeze of 4 or 5 years ago, the impact it had on prices. So there's no doubt that the big picture is that we still see reasonable levels of buyer and seller activity during times of economic stress. We don't see sharp declines in house prices. And I think that in these circumstances, we're really having a black swan event that's impacting the economy rather than issues to do with fundamental issues underlying the economy, which we saw back in the GFC, of course, and the previous recession. So it's as though we've sort of hit the pause button, and now we're starting to hit the it's time to get going again button. So it's not going to be going back to exactly where we were, but where we were was still in a reasonably positive position. And going forward, I don't think the issues with unemployment are going to have that much of a significant impact on the housing market. And we're seeing that already, Cheryl, with sellers clearly coming back into the market over the past week. Buyers are still a little not as active, and the Sydney market particularly is looking as the outstanding prospect, or certainly the outstanding performer at the moment. But again, it does rely on the economy going forward. But Australians are very attached to housing, to the housing market. We've seen that in previous periods of economic stress. And I think we're seeing that now in certainly some better signs in terms of a recovery being sustained.
Yeah, and definitely in the forums, and we've got a lot of real estate agents in the forums,
Yep.
and it really is good to see that they're like, well, we've had loads of people come through for social distancing, but they've been coming through.
And we've got to understand that the market is always a hostage to the bad news, good news cycle. Clearly, it's almost Groundhog Day. If we go back a year, buyers and sellers were inactive because there were all those predictions of 40% price falls in Sydney and Melbourne in 2019. Now, what happened, of course, was prices actually increased by 15% in Melbourne and Sydney over the year to March. So, it only lasts a short period of time, those negative sentiments, particularly in the market, and the fundamentals start to kick in. But we are a hostage in the short term to that negative news cycle. But once that passes, we get back to fundamentals. And that's what's happening now, of course, because we've got better news coming through, Cheryl. And people are now saying, well, it's not going to be as bad as we thought. I think the economic news will be better than many have predicted going forward. And that will only add to bolster confidence in the housing market. At the end of the day, we were undersupplied, because of the sharp decline in new development over the last year or two. We were an undersupplied market. Now, the key is migration, of course. And I think the government's really got to get their thinking caps on to, maintain our migration at reasonable levels. But even having said that, with falling migration last year, we still had strong housing markets, courtesy of local owner occupiers. So, it's not all be all in terms of one particular driver, but the signs are very good at the moment for a better outcome than many predicted.
And should we be looking, we, international investors as well play a part, and with, and the extra duties. I've spoken to international investors, and they're like, we would love to invest in Australia.
Absolutely.
Absolutely. We're just being hamstrung by the extra cost.
Yeah, look, that was a very cynical approach by governments during the boom 3 or 4 years ago, when they did restrict access from international investors and developers by putting up charges. And that was just a political response to concerns over, which are really, ridiculous concerns over in regard to overinvestment by international investors in Australian real estate and or residential real estate. And I do think, that we need to be taking advantage of every demand source that we can have. And that obviously includes international investors, particularly investors from China. We've got to really work hard at improving our relations with China. There's been a lot of loose talk lately. Let's move on from the coronavirus. This is about the economy now, Cheryl. We need to be very positive about that. And, China is a big part of our economic equation, just as it is a big part, potentially a big part of looking for some other demand sources for our real estate. And look, we've done very well with in terms of our coronavirus outcomes. And that's another tick for Australia in terms of investment. So, as you said, absolutely, let's look at easing those financial restrictions to international investors and developers.
Yeah, and let's talk about these government measures that have been put in place recently. I mean, big talk about the $25,000 grants, and is that going to have a substantial sort of effect, do you think?
Well, I don't want to sit on the fence, Cheryl, but I certainly the jury's out, and there's been some questions over these policies, particularly in regard to the renovation policy. I'm not sure that those with the capacity to spend the sort of monies that you have to become eligible on renovations wouldn't be still waiting to see that there's going to be some clear air in terms of the economic outcome. Those people, would typically be in higher wealth profiles. So they'd be more likely to be, waiting and seeing in terms of what's going to happen in the shorter term going forward. In terms of the support for new build, look, that's a positive. But we've got to understand that new building is different in terms of its profile from capital city to capital city. Of course, Sydney's not really a new build in terms of detached dwellings of houses. Is not really a significant new build destination. It is more about apartments. And Melbourne has 40% of most dwelling approvals typically, house approvals typically. So it favours areas such as Melbourne and Brisbane, which have the capacity, particularly for those outer suburban new home and land packages. So look, there's some issues there. Let's wait and see what happens. I do think that even though first home buyers can take advantage of this particular policy, that we need to be activating as many first home buyers as we can in this environment, because history tells us they're always a fertile ground for demand. And as we said, in regard to internationals, first home buyers are also part of, I think, the part of the solution going forward, even though they are part of the current government policy. But we've got to use the housing market, the property market. It's almost a no-brainer in terms of it being its capacity to revitalise the economy.
Yeah, and Andrew, do you have the numbers around the percentage of buyers that are owner-occupier and investors at the moment? Because we've talked a lot about, the owner-occupiers bolstering the market. Where are the investors sitting?
Well, look, it's interesting, Cheryl. Time constraints meant I couldn't look at buyer types, which I typically do in the presentation. But last year was clearly an owner-occupier revival. Investors were still a little light on the ground, particularly the second half of last year. And I think that was, again, a continued, hangover from the credit squeeze. I think banks were still a little hesitant to lend to investors. In fact, investor numbers are very low in terms of the historical proportion of market activity. And it was interesting because, a lot of the, a lot of the reasons that have been put forward for the revival last year, or one of the reasons, was the re-election of the Morrison government. Because if you remember, the Labor Party had promoted a policy of restricting negative gearing, and that was supposed to restrict investor activity if it had been enacted. But having not won the election, you would have thought that investors would have sort of been back in the market, in higher numbers, because they maintained their negative gearing tax advantage. But that didn't happen. In fact, investor numbers only really started to pick up generally in the very end of last year. So it was an owner-occupier market. And the reason is because owner-occupiers were trading up into the market because prices were still lower than they were 2 years before. And of course, with lower interest rates, it meant it was a good time to buy, and that continued this year. So we don't really totally need migration. We don't totally need investors. because it's a rich, I guess, tapestry of other factors that generate the housing market. But certainly it was owner-occupiers last year. And I think owner-occupiers will be the short-term drive into this market now, as we saw last year. Investors, we've still got some issues with our rental markets at the moment for various reasons. Again, I didn't cover that because of time constraints. But that's another reason why we should get first home buyers up and running, because if there are any issues in terms of finding a tenant from investors or competing with Airbnb properties, then those properties can, in a sense, be transferred in the marketplace to first home buyers. So we don't have that sort of stress sale environment. But, you know, investors are always a strong force regardless in our housing markets. And that, of course, just reinforces the sort of the robust and resilient nature of our housing markets. And again, I think that the government could think to giving incentives to investors to help to activate them back into the marketplace as well, given they are at low levels historically at the moment.
Yeah, I think that's an interesting point about the owner occupiers, particularly for developers who are looking to be doing something in the next year or two. If that's where the strength is, look at the type of product that you're providing. And the locations as well. That's where David and his fancy Archistar comes into play.
Definitely.
Excellent. Well, David, I just have a quick question from someone in the group. Dan's asking how current is the information on Archistar, and where is this information coming from?
So it's very current. It's coming from different planning portals, councils, different sources. You know, we've got access to live APIs, so it's updated continuously. So New South Wales planning. I didn't have a lot of time to go through the platform in detail, but you know, there's a massive digital planning library there too, giving access to every state, local government document when it comes to planning. So yeah, it's very current.
Yeah. So say for example, if the listings on Domain or re.com, they're live.
Yeah, that's all live API. So we have live access to CoreLogic's API, Cordell, and Domain. So all that data is in real time.
Excellent. Excellent. Well, I've noticed that we've gone a little bit over time, but it was extremely informative information, especially for you. Thank you, Andrew, for making the time. Keep warm.
No problem.
And I think, you know, for the group, it is reassuring to be able to see that there is, you know, empirical data supporting that we are on the right path. Excellent. And David, what we'll do is, and also post up that deal that we have for Archistar on the forum.
Yeah, so I can, you know, really stress that it's really valuable to give that a go now. I mean, it's a special offer for the group here, and there's no lock-in period. So, you know, fantastic time to look for opportunities, and there's no better way to do it than using our platform. So I hope everybody takes up that offer for a month and gives it a go. I'm sure they're going to love it.
Excellent. Thank you so much. Thank you both. Thank you, Andrew.
Thank you, Cheryl.
Have a great afternoon. Take care. See you soon.
All right. Thanks, everybody. See ya. Bye.